Welcome to the Lend Academy podcast, session number 12. Okay, today on the podcast, we have Alex Tonelli. He is the founder and managing director of Funding Circle USA. It used to be called Endurance Lending Network. That's the company he started with Sam Hodges back in 2012, and they merged with Funding Circle UK in October of 2013 and became Funding Circle USA. So we'll talk a little bit about that merger. We'll talk about his business model, how it's been going, plans for the future, and just all about the kind of borrowers they're getting and the kind of investors and the opportunity that he sees. And of course, we'll also touch on Lending Club with their entrance into the small business space. So hope you enjoyed the podcast. Okay, welcome to the podcast, Alex.
Thanks, Peter. It's great to be here.
Okay, so let's just get started with a bit of background here. Wanted to sort of get the story a little bit, talk about, you started Endurance Lending Network with Sam Hodges. You merged with Funding Circle UK last year. So can you just give us a little bit of background about your journey here and how it's been going since the merger?
Sure. Well, increasingly we like to remove distinctions, and I like to say one team, one dream. So we consider ourselves all Funding Circle now. But it's been a fun ride, and it's amazing how we put a lot of things on PowerPoint slides as we were doing the merger and the joint capital raise that came with it. It was a $37 million capital raise from Excel, Index, Ribbit, and Union Square Ventures to make it happen. And it's the theses around what being a global platform could provide, that the learnings would transfer across geography, that capital would begin to flow across geography, have all come true. And so the business in both places, and particularly in the U.S., which is where I sit, feels a bit like a hot knife through butter, and frankly, it's exceeded our wildest expectations. Working with our partners, so Sam Hodges and I are the co-founders here in the U.S., and then we've been joined by Andy Mullinger, who runs credit globally for us, but is also now based in the U.S., as well as our partners Samir Desai and James Meekins. Our partners have been phenomenal. They've built a phenomenal business in the UK and have been an amazing resource for us as we grow here. It does feel a little bit like filling out a math test with the answer key, meaning you still have to work out a lot of the problems, but you really know where you should be getting. And so they are, it's allowed us to run, not walk at the answers to these problems. And instead of running into walls at times, Samir, James, and Andy, who are incredibly impressive partners, and we're lucky to work with them, have been able to point out the walls before we run into them, and that's been a huge benefit as well.
Okay, so what are some of the things? It's been 6 months now almost. What are some of the things that have surprised you? You obviously had some ideas about it when it all came together. What are some of the things that surprised you about this merger?
It's just how applicable and how close the metrics are to what they are in the UK, and so how we knew that a lot would transfer over. We thought that there would still be there would be building around. A lot of combining and working around, but really, the business does translate very well between the two geographies, and we're assuming in new geographies as well, which bodes very well for our longer-term vision of being a global, not just two-nation, but a global platform.
Okay. So why don't you just describe for the listeners, your business model, what your business model is here in the US, and how it's similar and how it's different to what it is in the UK?
Sure. So it's similar in its economic terms. We take a 3% origination fee from borrowers, and we take a 1% servicing fee from investors. And so that's a pretty simple, commonly held practice amongst marketplaces of our type. We are a marketplace in that we originate loans and grade them from small businesses looking for up to $500,000 in the U.S. and £1 million in the UK. and then we put them on a marketplace for consumption by investors. My guess is that you'd be interested to hear the nuances of how you might be able to invest in the platform. The simple answer is that there is an auto-allocate way of investing, and that there is a way to pick and choose the loans that you have interest in. One of the most meaningful differences between our two platforms is that in the U.S., frankly, unfortunately, we only are able to accept accredited individual investors and institutional buyers. We at this point can't take retail customers, though at some time in the future that's something that we would absolutely love to do.
Right, and in the UK that's not the case because they obviously have a range of retail investors on their platform there.
Yeah, that is probably the most meaningful difference between our platforms is that in the UK it's almost entirely retail capital, which is a big credit to what they've built there because it's hard to do it like that.
Yeah, it is.
And it is. As you well know, Peter, the retail business in the UK is booming, and now we're starting to add, this is part of the global component of how do we get the rabid appetite from institutional investors to interact with our UK platform, which is now quite sizable and growing very quickly to the point where institutional capital can really help to add fuel to that fire.
So then are you hearing from some of your investors that they would like to access the US platform and the UK, sort of get a double benefit, through one organization? Are you seeing that?
Absolutely. And that is one of the, I wouldn't call it surprises, that was one of the theses of the merger, was that, we're a marketplace, and marketplaces in their truest form are as open as they can possibly be. And we're trying to be a global marketplace. And so, there are, of course, barriers between nations and, based on where people are domiciled and things of that nature. But what we're working on is trying to reduce those barriers meaningfully, which we think in the long run will mean for a much more solid, stable capital market and, ultimately a much more robust marketplace business.
Okay, sure. So let's just switch gears a little bit. I want to talk about the borrower side and talk about the kinds of businesses that you see applying for loans today. I know you've often focused on you started off focusing on the franchise market. Is that still the case? And can you tell us, who are applying for loans?
Sure. So the franchise channel is a meaningful channel for us. It's one that we like very much. It's got a lot of attention. I think it resonates with investors for a lot of reasons. But, to clarify, it's not our focus, meaning that, it is just one of many channels that we pursue for acquiring borrowers. In terms of what type of borrower you might see applying for a loan, I would say, go to any town, and I mean town, not city, but go to any town and walk down Main Street. That is, those are the types of businesses, and of course we run the businesses in cities as well, but if you walk down Main Street of a medium-sized town, you'll see the types of companies that come to us. There isn't a concentration of industry, other than what you would normally expect. It's much more of a stage of business. And I think this is a nuance that's lost amongst a lot of people, is that people say, we're hearing a lot about small business lending. It's great that you and they'll name some others are looking at small businesses. And it's funny because I think of it like the beverage aisle. You don't walk into the store, generally saying I want a beverage, and then you go in the store and you look at, vodka and coconut water as clear beverages and say, oh yeah, these are about the same.
Right.
By the way, I like both vodka and coconut water, so those are, there's no value judgment placed on that.
Okay.
But in reality, people go in and they're looking for Yoo-hoo, or they're looking for milk, or they're looking for soda or something, green soda or whatever it may be. And small business lending is much like that. And so what we are doing is we're looking for the types of businesses that are attracted to what I call a loan a bank should do. It's a term loan. It's a 3 to 5 year loan that helps that business to make a meaningful expansion project in one way or the other. There's other flavors of small business loan, but they're very meaningfully different in the same way that vodka and coconut water are very meaningfully different, even if they may have similar characteristics.
Right. Can we actually extend that analogy to say that, some like too much vodka is not very good for you. Coconut water is a little bit healthier. So what you're trying to provide, you would say, is something that's, let's say, a bank should do. A bank maybe can't do because of their cost structure, but you're stepping in there with a cheaper cost structure. And there are certain organizations that, we've talked about the merchant cash advance business where they're very high rates. And maybe if if a business gets addicted to them, it could be very bad for the business in the long run. So would you say that you're only looking at loans that it's a true win-win for all parties? Is that what you would say?
Well, I try not to place value judgments on it. Like I said, I like drinking vodka, but the value judgment of it, it's really more about what's the effect of it. And there are certain business situations where taking a 75% 6-month loan may make sense. It might be in a situation where a business can't possibly expand its inventory unless it has a very quick injection of capital. It may be a situation where the business is in some trouble and they need some money to get through a very rough patch. And so, I wouldn't put a value judgment that
okay,
bad.
Fair enough.
That is just a different type of customer. When you ask what type of customers do we attract, it's generally a business that's been up and running for several years. It is thriving. It is thinking about a way to expand its offering and grow. And that's a loan that is more typically done by a bank. And so, but unfortunately, banks aren't doing their job. If banks were doing their jobs, then we'd be in a very different world. We don't think that banks have interest in lending really under $2 million to, they might do it as part of a larger product offering. They might do it on a one-off basis for one reason or another. But in general, banks aren't lending below $2 million, and we're trying to fill that space.
Right. So can you just talk about the product you talked about, like a 3-year loan? Are you still mainly doing 3 years? Do you offering 5-year as well, and what are the range of interest rates that your businesses pay?
That's right. So we're offering a 3 to 5 year product with interest rates between 9.9 and 17.4%.
Okay, that's an APR, or is that just the interest rate?
That's the coupon, okay. And then there's our 3%, and we have a 3% origination fee to the borrower.
Right.
It speaks to one of the things that we espouse to be, which is transparent. A big problem in the industry is that we call them loan sharks, and if you're coming to this very exciting conference called Lend It, you'll see our loan sharks that we have in our office floating around,
okay.
Which really represent the arch enemy of Funding Circle, which are these companies that might advertise, a 14% interest rate, and they really mean 14% per month, or they mean, 14% before hidden fees plus 3 months last payment paid up front. There are really a lot of different ways to juice that interest rate. And so it really isn't uncommon to see a 14% interest rate actually mean an 80% or sometimes even a 400% interest rate. And because lending to businesses isn't as regulated as lending to consumers is, there is no concept of an APR in small business lending.
Right.
And so, we think that that's really wrong. And so we try to be extremely transparent with our rates. And that's one of the things about the business that we think needs to be fixed. And over time, we're espousing for our rate, we're espousing as a marketplace to bring as many products to that marketplace where we can accurately judge the risk as possible. And so as capital interest is coming onto our market, we'll see rates improve for the very best borrowers, and we'll see new products that will attract borrowers who have perhaps a less strong credit profile.
Okay. Yep. So how are you attracting your borrowers? Are you using online channels, offline brokers? What are the main sources of borrowers that are coming today? We
attract borrowers in two principal ways. One is through performance marketing channels. Nothing that will shock you, which is the mixture of online and offline marketing strategies, more traditional marketing. And then we have partnership channels of very different varieties and sorts. And those partnership channels are with, you mentioned, brokers would be one such channel. You mentioned earlier franchise would be another such channel. And then, partnerships with a wide array of other aggregators and actually one of the big initiatives over the next 12 months is to really make some game-changing partnerships with some more innovative companies that we're working on in order to get better borrowers with better data so we can analyze them better and make more loans. And so you should expect to see something like that in the near future. One exciting thing I'd point out that our UK business is doing is starting to partner with banks. Mm-hmm. And this is something that when we were thinking about the early stages of the business, we had always thought what happened was our advantage of being able to do these types of loans would become an attractive thing to banks, and they would begin to partner with us either in providing capital or referring leads in a meaningful way. In the UK, we are, for some banks, we are going to be doing all of their underwriting of loans for loans under a certain size. Right. I think that speaks to how powerful the IP around our credit analysis, and that's a credit again to Andy Mullinger, who has built that from scratch, how powerful the credit analysis process has become, such that we are now taking over this function for certain banks.
That makes perfect sense to me, because banks don't really want to say no to. Someone might have an investment account with the bank or a checking account, and they don't want to say no, but they just they're the people who who set up the criteria for what they can lend, set it up. So, I mean, it makes sense for them to say, hey, just go over to Funding Circle. They'll look after you. And, they would even be able to, I imagine, have a pretty good idea whether they would get approved over at Funding Circle before even sending them to you. Would that be correct?
Yes, that is. But keeping in mind that, the banking industry as a whole moves somewhat slowly.
Right.
And so, to make an understatement. And, this is an evolving process, and we're starting to see the very early signs of how powerful the Funding Circle marketplace can be.
Yep. So, okay, let's, I wanted to talk about your loan book. When I chatted with your partner, Sam, about, almost a year ago now, and when you were still in Endurance Lending Network, and back then you had 0 delinquencies, and it was a young loan book. It was a very young loan book. So I wanted to ask if you are still at 0, and if not, are you still tracking to your, back then it was 0.5% to 1% projected annual loss rate. So where are you at with your loan book now?
Sure. So when the merger happened, we had 1 delinquency, and today we have 1 delinquency. So we're very proud of that. But again, and not to overly reference our Chief Credit Officer, Andy Mullinger, but I don't want to take credit for his sayings. The purpose of risk is not to underperform or certainly not overperform or overlose, though losing less would be better than losing more. The purpose of risk is to get it exactly right and lose exactly what you expect to lose.
Right.
So in that sense, we have been too conservative, and that's a good thing. We need to build investor trust. But yes, we're very thrilled to only be at one delinquency, and it means that we have the ability to, on that 1 delinquency, we recovered a substantial amount of that loss, which I think helps to validate our recovery process, and the fact that these are secured loans, which is another difference in that vodka coconut water analogy, is that as a secured loan, we're much more likely to, they are safer, much more likely to recover. At the same time that, these loans really can be done in a very safe manner that does track to those loss rates you mentioned. A big significant update from when we last spoke was we have launched new risk tiers. So in the UK, they have, static cohort data around, a much longer track record of loans and loans that have run through maturity, and certainly longer loss curves. In the UK, the overall loss rate in the book has been 2.2%. Mm-hmm. But they also have a much wider array of products. So they have products that are much lower on the risk curves. In the US, we've now launched, we've taken that original loss expectation that, what you referenced, the 50 bips to 100 bips loss rate, and that is, our A+ loan category. So, we expect 60 basis points loss in the A+ loan category. That is, these are in line. We're using a combined model with the UK credit system. So A+ has 60 basis points loss expectation. A loans have a 1.5 percentage point loss expectation, and then a B loan category, which has a 2.3% loss expectation. And again, the goal is to hit those loss expectations, not over or underperform them. And frankly, we are under losing at this point as compared to our projections.
Right. Yeah. So you should, in some ways, you need to get a little bit more aggressive. Well, honestly, aggressive is not the right word, but you need to sort of bring in more borrowers so you can meet those loss expectations and, adjusting your underwriting accordingly. So that sounds good. So then, so obviously the interest rates, I presume it's like the Lending Club and Prosper model where, the lower risk, the A+ have the lowest interest rates, and then moving down the credit spectrum, they increase. Is that how it works?
That's right.
Yeah. Okay. So let's just talk about your investor platform. And, you've talked about accredited investors, you have institutional investors, and I heard you are developing a marketplace. Is that marketplace live yet for investors? If not, when will we be able to see that?
So to be clear, we are a marketplace, and we are functioning as a marketplace. Accredited investors cannot yet access the marketplace.
Right.
So accredited investors can only participate through a auto allocation process at the moment. But that is changing. At the end of the second quarter, so end of June, accredited investors will have the same ability as institutional investors to pick and choose the loans that they want. So, we are very much pick and choose marketplace. That said, we're building very quickly the capability to allow accredited investors on there. Part of the reason that it is probably taking longer than we would like is just that we are, or maybe not longer than we'd like, it's exactly as long as we had hoped, or as we had planned, but the reason we planned for it to take longer to roll that out is just because we have the resources and the team to build not, sort of a V1. We can build out a more robust later stage product that will work better in the long run, because we're beefing it out and really going for building something great. And that doesn't mean that there won't be an iteration cycle, and of course it's going to be an ongoing process. But when we do launch it, it will be something that we'll be very proud of.
And that will be fractional loans will be available. Like investors will be able to say, right, I want some of that loan, some of the other loans. Is that how it's going to work?
That's absolutely right. Yes.
And what will be do you have the minimum per loan that investors will be able to invest in? Is that set yet?
We haven't announced it, but if you attend the conference that is going to be a bellwether in our industry, we'll have called Lend It. There will be probably announcements about that and other things.
Well, there you heard it, folks. Lend It conference on May 4th to 6th, a must-attend event. Thanks for the plug, Alex. Okay.
That's what I've heard. That's what I've heard, Peter.
Right. Okay, so then let's just talk about the balance between the investor and the borrower. I mean, we've seen Lending Club and Prosper, the balance shift back and forth. Where are you at now in that search for equilibrium? Do you have more investors or more borrowers? Where's it at?
Frankly, we have too much of both, and that's a great thing. I mean, there's never too much, and what we're trying to do is grow responsibly. One of the great credits to Lending Club is that they've grown very predictably for quite a long time, which is no small feat, and we take our hats off to them. We want to make sure that we grow. Already now we're the fastest growing peer-to-peer lender in history, because we're growing at an incredible rate. You don't want to grow irresponsibly, and you want to make sure that your systems and processes are there. And so the answer is we're trying to build those systems and processes in a responsible, diligent way to be able to handle the ocean of both borrowers and lenders that are out there. And that's the exciting thing in the business, is that we've seen our partners in the UK prove out that this works. We know how to do it, and then we come to the US, which is just an even bigger, much robust market than in the UK. And so if you asked our global CEO, Samir Desai, about this, he would say, yeah, it's exactly the same, except in the US, everything is just bigger. And so, we are experiencing an abundance of demand on both sides.
Okay, that's good. So can you share any numbers with the listeners? Like where were you at with loan volume in Q1? What's your projected volume for the entire year? Is there any numbers you can share?
Sure. we are aiming to lend $100 million in 2014 in the U.S. and call it $650 million globally.
Wow.
We are tracking to those numbers and are on a very strong pace. And so we tend to think of things as a latest and greatest. This month, I would expect us to do $4 to $5 million based on our run rates so far in the month. And things may slow down in the month, and maybe we don't exactly achieve that, but it'll be pretty close. And given that trajectory, we should be able to hit that $100 million in 2014 in the U.S.
Okay.
But regardless, we're extremely excited about the growth prospects, and these businesses can become the businesses get very powerful when you can turn on one lever or another and sort of move it in a direction you want it. And the UK business is certainly getting there. The US business is getting there very quickly.
Okay. So I can't let you go without talking about the Goliath in our industry, Lending Club. I'm sure you're very aware of what they're doing, and they announced last month that they've started issuing small business loans that seem to be in a similar kind of range to what you guys are doing. They're doing more of the between the 2 and 5 year loans and similar kinds of interest rates. So how do you feel about Lending Club coming into this market?
So I guess I'd start by saying we are incredibly motivated by empowering small businesses. It is our mission is to build a better financial world, and one half of that is to build a better financial world for borrowers who have experienced very difficult times in raising capital, which, slows our economy, slows our country, slows our world.
Mm-hmm.
And I am, you may have talked to me before about, certainly personally, but, or one-on-one rather, the fact that I was a small business owner who had raised $100 million from banks to do crazy private equity deals, but I couldn't raise $100,000 for my extremely successful chain of fitness centers,
mm-hmm.
and thought that was absolutely nuts. So, the reason that I bring that up is to say that I am thrilled that small business is getting so much attention from well-financed companies that can help address the problem. Our country needs this. Our world needs this.
Mm-hmm.
To make sure we think about this globally. We need better solutions than what banks provide. At the same time, I'll go back to the beverage aisle with you and say, well, actually, before we get to the beverage aisle, I'll say certainly what Lending Club has built is amazing, and to quote Ron Super from Prosper, I pray every night for the successful Lending Club IPO.
Okay.
I do, right? And obviously that is something that they have done a lot for alternative lending as a whole. The notion of a Goliath, however, is something that I find interesting because we're all just drops in this bucket. When you look at the size of, forget consumer loans, which is huge, but small business loans is a $250 billion annual origination market of companies that are getting funded. Forget the ones that aren't getting funded. And so, when we look at that and we think about the volumes that we're all talking about, we're all very tiny. And so
right.
When I think about our competitors, certainly we compete on, in Silicon Valley and in the West Village, and in the mindset of the very informed, public around new and emerging technology companies, we certainly compete for mind share there. But on Main Street, where we're talking that borrower that you walk down Main Street with, we don't compete with these companies, these other companies, because they're offering very different products. And so to get back to that beverage aisle, the Lending Club product on the surface, is a small business lending product, but it's more of a working capital type of solution. It's more like a credit card for small business, which frankly, I think does make sense. I pay down my small business credit card every day. And so, the fact that Lending Club is coming out with a product is something that I'm sure that, businesses that have a particular need that they'll want, will go to Lending Club. However, I think in our approaches, at least from a lender's perspective, we're pretty far apart and serving very different needs.
Mm-hmm. Okay, so it sounds like what you're saying is that there's room for both you for many players, and really the Goliath is not it's not Lending Club. It's it's Bank of America and Citibank and Chase and that sort of thing. That's really, is that what you're saying?
Absolutely.
Right. Okay. Great. Well, I really appreciate you coming on the podcast, Alex. This has been great. Best of luck for you, and I look forward to seeing you at Lendit in a few weeks.
Thanks, Peter. We're all really excited about Lendit and can't wait to see you there.
Okay. Thanks. See ya.
Take care.
Okay. One thing I just want to touch on that Alex mentioned towards the end there, and that's about the size of this industry and who's really the Goliaths. And if you take the value, I saw this at the AltFi conference, Simon Champ mentioned this, and I did some research to verify it, that if you take the total value of every loan ever issued globally in the peer-to-peer lending industry, it is still less than 1% of the assets on Deutsche Bank's balance sheet. That's one large bank. The whole industry globally is less than 1% of those assets. So we've got a long way to go. And the point taken is that really the competitor here is not Lending Club versus Funding Circle or Prosper or what have you. We need to work together to grow this industry so it can become a viable alternative to the big banks. So on that note, I will sign off and I will catch you next time. Thanks. Bye.